Welcome to the Anton Stentner podcast. Today we're talking about how bad the economy really is. Is it broken? Actually, I think it's broken. Anton's strategy to get through deflation and stagflation. Well, first off, tell me, how is it broken?
It's broken because the talking heads are like telling you everything is fine, the economy is booming, the data is good, but there's the iceberg hiding below the surface. There's dangerous stuff that's hiding there, and we're essentially like in this economic paradox where we've got a two-headed monster. One's leading us towards deflation, the other one's leading us towards stagflation, and the headlines are lying to us. And so in this episode, I basically want to show you why, talk about the data, talk about what's important. Of course, you need to make your own decisions, and we want to then figure out what can we do about it? How can we help our listeners, our subscribers to move forward? And so first off, let's just talk about like a confusing headline so people are on the same page. GDP is up, but skilled workers, we're talking white collar workers, are being laid off. New orders are up, but there's a staggering number of companies that are like expressing demand in the near term. And does this make sense? I mean, seriously, like when you think about this data, does it make sense?
Really confusing. Even, just looking at the stock market, we're hitting all-time highs, right? But you know what else is hitting all-time highs? Gold. Usually gold is a huge warning that things are inflating.
And we're going to talk about that specifically.
So those are contrasting kind of markers right now.
Absolutely contrasting. So the stock market, one of the things that you guys should go look at is go look at the .com bust and look at the price per earnings ratio and revenues and look at where we were then and where we are today, and your heart will go, and then realize September just on a natural level is usually a down market for the month. And so we want to talk about, like, first, you've probably never heard of this idea of good deflation, but what if I told you that our newest technology, AI, is kind of forcing that to happen? So let's talk about deflation real quick. Deflation is, in a simple way, it's a decrease in the general price level of goods and services, which leads to increased purchasing power of the dollar, which sounds good on the surface. And this is what everyone wants. When you listen to people, you read comments on Reddit, you look at things on Instagram or Twitter, or X, I guess it is now, everyone's like, I want prices to go down. Well, if prices really genuinely start going down, that means the economy is in some type of a free fall. And we did have good deflation in the 1870s during the second industrial revolution. Okay.
We're going way back now.
Going way back. So deflation can happen when productivity massively increases, and that can cause prices to go down. So force number one, AI is showing up already as a productivity shock. This is our new steam engine. This is the new cotton gin. And a survey by the St. Louis Federal Reserve among workers who use AI on a regular basis said it was saving 6% of work hours and increasing productivity by 1 to 5%. So this isn't a benign form of deflation. This is a radical change in technology. And what we're also starting to see is a white-collar recession because of this. You're seeing middle management get laid off at these tech companies. You're seeing structural changes in the way people do business. I know in my own personal businesses, our salespeople and our admin people, their productivity is massively shooting up. Even how I prepare for these podcasts has fundamentally changed since we already first started.
I have an example of literally how much I saved. So
yeah, please.
I run events for creators, and I've been doing events forever, and I always liked having a flyer. Now it's a digital flyer that you just slap onto your website.
Yep.
It just gives a visual. It's kind of like the header has the title of the event. In the last couple of years, I'd hire a local artist to make something really cool, something kind of different. I didn't have a lot of time. I didn't want to wait. So I was like, let me just use this ChatGPT. I mean, we're talking 20 seconds. I had tons of options. Then I dialed it in. So within 5 minutes, it was, I'd say 90% of what I would expect from an artist.
Why?
Cost me $0. I normally pay that artist at least $300 to create that flyer. And now I just saved myself $300. So just, I mean, if I'm doing 4 of those, I'm saving $1,000 just from one thing. And not just that, I'm saving time, because normally I send them the concept. Maybe it's like a phone meeting, then back and forth an email. So not only did I save $300, I probably easily saved myself 3 to 5 hours of work.
Yes. So magnify that across the whole United States, the whole economy.
Definitely happened.
Yeah. So AI, force number 1. Force number 2, inventory bloat. So this is a significant deflationary force with widespread inventory buildup. Well, why are we having inventory buildup? 2 reasons. We had the tariff announcement, so everyone bought a whole bunch of stuff because they didn't want to pay more for tariffs. We bought stuff for our own real estate investment projects in advance. We were part of this. But then the consumer starts slowing down and starts purchasing less. So not only do we have more inventory on the books, the consumer is purchasing less. Well, what does that usually mean a business has to do if they have too much of anything?
Just lower the price and get it sold.
They got to lower the price so they can kick it out and get it sold, which is deflationary.
In Canada, they're not buying our bourbon. And that's a real thing. I saw the news about it. Oh, we're protesting American products. So they're like, hey, here's some Canadian whiskey. I went up to Vancouver, BC, a friend's restaurant, and I was like getting old fashioned. It's like a nice steak restaurant. He said, yeah, I'll have old fashioned. He goes, oh, what do you want in it? I was like, oh, I'll do a bourbon. Oh, sorry, we got no bourbon. I thought he was joking around with me. I go, oh, really? He's like, yeah, after all the tariffs, we just stopped buying all your bourbon. And he wasn't even trying to be mean or anything.
Yeah, he was just being
straight
real.
up real.
Yeah.
It's like, it's across the board. So I imagine bourbon is probably unique, but it's not unique that there's probably inventory from that too.
Yes.
From that tariffs in other countries. I know in Mexico, the prices are jacked up because of the tariffs. So when prices are high, people don't buy as much.
Bingo. Tariffs are a tax. I mean, I've said it before. I'm like 65% against tariffs, 35% for tariffs. So we got this inventory. We've got AI. Both of these are pushing down prices. And the government is unleashing a different kind of monster that could throw us straight back into the 70s right now. And that is an old enemy returning to us, AKA the threat of stagflation. See, stagflation is actually worse than inflation or disinflation. Stagflation is an economic state defined by stagnant growth, high unemployment, and high inflation. Well, interesting. Is inflation going all the way away right now? No. Is unemployment rising? Yes. Is the government slowing down their hiring? Yes. Do we have more debt than ever? Yes. So we've got this pressure that's coming in, and then all of a sudden, so let's talk about these different kind of, we've got 2 forces that are really threatening us with stagflation here. We've got the tariff tango that we've been working on. So this is really a textbook scenario. Tariffs are inherently inflationary because they act as a tax against the consumer, and it raises the prices of the goods they purchase. And this month, if you didn't see the news, the U.S. Court of Appeals in the federal district ruled that tariffs were illegal to use under the International Emergency Economic Powers Act, but delayed taking action to the Supreme Court. So here's what they said. It's illegal. They punt it over to the Supreme Court and say, hey, you deal with it. What that means, though, is now the Supreme Court, we knew it was going to go to the Supreme Court the whole time, but the Supreme Court is going to have to make a decision. And if the Supreme Court makes a decision that tariffs are illegal, the way we're currently doing them, and that Congress has to vote on them, the president couldn't do it the way that he wanted to do it, what do you see as the biggest problem there?
If we have more tariffs?
No, if they're declared illegal. We're going to have to give back all the money we already collected to the tune of like 100
to other countries?
Yes.
Oh my gosh.
If this is declared illegal, they're going to have to go find an extra 160 billion so far in the budget. P.S. Every month, that number will keep rising. So by the time it gets to the Supreme Court, we could be giving back $250 billion, a third of a trillion. And then how are they going to do that? Well, the government's going to have to pay the bill and they got to print the money.
Oh, wait, let me ask you this. Do you think it's going to happen if you had to make a decision?
So we're making a bet?
Yes. Only if we disagree.
Yeah, true. My bet on this one is the Supreme Court is going to uphold it because there is a lot of national push towards this. There's a lot of national sentiment. And the Supreme Court is slightly more conservative than they are liberal. And the...
AKA Trump supporter.
AKA... Trump nominees, but also even the ones that are more moderate and liberal over the past year have been very much voting pro-economics, pro-United States, pro-America. So I feel like the Supreme Court. But what I'm trying to do for our regular listeners, our subscribers, is set this up so you see the problems that are coming and that you know what to do. Because that's what this is. This is a huge one. Okay. This one's been coming for a long time. Force number 2 is the demographic time bomb. The U.S. population, workers aged 25 to 54 has barely changed, while 65 and older has increased by nearly 5 million since 2019. That means our labor pool is shrinking right now. Plus, we've been deporting a bunch of people. A bunch of illegals, and we should deport people who didn't come into the country. However, that shrinks the labor pool, which puts sustained pressure on interest rates and on inflation. So with this tug of war, all these forces are essentially this ticking time bomb getting ready to attack your wallet. Well, what's happening then is we've got this consumer that may be ready to suffer the final blow. And remember, we're a consumer-based economy. The consumer has to keep spending for the wheels of this machine to keep moving. So we've seen these conflicting forces, but what could tip the scales? And the answer is the consumer's wallet. We've got a debt-driven slowdown. Total household debt in second quarter of 2025 reached $18.4 trillion. Oh my goodness. Simply go Google this, look at the Federal Reserve's website, and you can see it's a hockey stick. It's just up and to the right. Plus, with interest rates being high, now we've got high interest revolving consumer debt that's taking a percentage, not just a percentage, a significant percentage of household income, which reduces the consumer's availability to spend. So I want to talk about one of the really big devils in this detail. And this is called BNPL. And I guarantee you've seen this on a website if you shop for something. Have you seen the button Buy Now, Pay Later?
Should be called Buy Now, BNPN. Buy Now, Pay Never.
It should be called that. And
not that I'm advocating for it. I'm just saying I know where this is going. Yeah, I mean, it's becoming a habit because their debt is already high. They're thinking, you know what? I don't have credit. Let me use this. I'll pay it off later.
And it's exploding. It's absolutely exploding. So the trap is they call it 0%. The consumer looks at it and says, oh, that's $200, but I get to make $50 payments until I'm done with it, and I can handle $50 payments because it's 0%. So the psychology is in that gamification of this is cheaper than it is and easier to pay for. And this is one of the worst things that's attacking our society. In 2022, it was $1.64 billion with a growth rate of over 24%, and it's expected to hit $9.2 billion by 2030. And who do you think is using it the most?
Gen Z. Oh, no. Millennials.
Bingo. Millennials, Gen Z,
Bigger
Gen
pull.
X, baby boomers. So
Bigger pull.
What's interesting is, yes, there are more millennials than Gen Z, and so 48% of them. Well, how many of them are late? Gen Z, 32% of them are currently late. Millennials, 25% of them are currently late. Gen X, 21. Baby boomers, 12. So what happens is they hit you with fees that are worse than these credit cards and late fees. And it's this trap because they paint it as it's easy, it's just okay. There won't be any problems, 0%. Knowing in the model that they're going to rake at least, 30 to 40% on the people who are late. Excuse me, that 30 to 40% of the people using the product will turn out to be late, and that's where they're going to make all the profit. So the retailer gets the money, and these companies like Affirm.
I see. Because a lot of these buy now, pay later, you don't have a fee if you pay on time.
Correct. 0%.
Oh,
Yeah.
I've never done it, so that's interesting.
Yeah, 0%. They give you a 0% loan.
And then are you going to talk about this last stat?
Oh, so that's actually just depressing. The majority of users, over 50%, say they regret using the product because it's a trap. Like, this is Star Wars. The guy looks over and goes, "It's a trap," and they just walk right into it. Combine that with low savings rates. So right now, we've got historically low personal savings rates, just 4.4% in 2025. And this lack of financial buffer means that shocks to the economy or personal shocks due to health or job loss can create more problems quicker and lead to a consumer downturn even faster because we don't have enough reserves. All right, so this is a lot to take in, but let's talk about what's happening in real time, what they need to pay attention to over the next week. So we've got two scenarios coming up, and then we've got jobs data coming up. And the big question is, which of these two competing forces is going to win? Because we've got these collision of massive economic factors. And the economy is, of course, dynamic. It's never in a state of equilibrium. So all of these are possible. And I believe we've got soft landing as scenario A, hard landing as scenario B. And of course, there is a whole range of possibilities in the middle of them. Scenario A, soft landing. This is productivity-led disinflation. In this scenario, the supply side effects of AI productivity gains combined with demand slowdown from debt and low savings overwhelms the inflationary forces. And this accelerates if the Supreme Court strikes it down, injecting clarity and allow businesses to restart hiring and investment. And we have rate cuts coming too. And the rate cuts will make more liquidity or access to capital available in the market. Scenario B, the one we're worried about that I want you to pay attention to. This is the hard landing. This is policy-induced stagflation. This is inflation from tariffs. This is structural wage pressures from demographic changes. This is the policy uncertainty. This is a paralyzed Federal Reserve, unable to cut rates because they're worried inflation is going to shoot out of control. And that could lead to that 1970s style period of high inflation, low growth, and lead us to that same economic and policy dilemma where all of a sudden you're like, oh my goodness, are we going to get Paul Volckered and our rates going to have to be jacked through the roof? So what I want you to pay attention to this week is the ADP job numbers. The ADP job numbers coming out this week, that's private payrolls. If they come out and we get a really strong read, that could be a signal for a bullish landing. If we get a nice weak read, so I want like a semi-weak read, like 60,000. Not too much to scare everyone, just enough to kind of settle in the economy. I think that would be best. If we get a really low read, it could be the Mayday signal. And that could be the sign that the stagflation and the disinflation is starting. And then we have the regular BLS jobs report. And we know that Trump administration got all pissed off and fired a bunch of people over at BLS. So this number, can we trust this number coming out? But if we get jobs data that doesn't have a huge number, in other words, it's not a barn burner and just blows it out like it did, when it got really low the last time. If we get 60,000, 70,000, it's kind of mild, kind of weak. That sets us up for a good rate cut, sets us up for a good soft landing. The problem is if we get a really low one, especially on the BLS data, and we get like 20,000 jobs and you get negative revisions, that could be the sign that everything is breaking and we're going to have to start cutting faster. But the problem is inflation is not all the way gone. So brother, you mentioned gold. Say that again, what you said, because you actually said it perfectly.
Yeah, I mean, so usually there's certain things that happen when the economy is doing really well. One of those is the stock market is booming, right? You can't really control it, but people get greedy, people get ambitious, and they just have a lot of confidence in the market, in companies, so they invest into stocks. And so what do they invest less into? Gold, because it's boring. It just sits there. You can buy gold stocks, but they're like, hey, no, I'd rather get the bigger interest rate, dividends from my stocks. So gold kind of gets put off to the side. When there's an economic crash coming, right? What's interesting is the market kind of knows it. Like people, like an individual thinks, you know what? I think I need to protect my wealth, and I feel like stocks aren't going to be a good risk to take on in the next year. Let me sell some stuff, or instead of buying stocks, let me buy gold. Now, gold represents all the boring investments, okay? This could even be like a land. This could be a thing. But gold, if it's getting bought up, it's like a sign of a huge risk on the horizon. But if both are going up, that's a conundrum. Right?
That's why we're talking about
because
it.
Right now the stocks are way up. I just, on the way here to the studio, I was looking at stocks. I was like, Trump's actually doing a pretty good job keeping that number up there, right?
Yeah.
We're at 45,000 for the, I forgot which one that is, Dow Jones.
Yeah.
And then I'm like, but my gold bars, I could sell them for $3,600 right now. That's actually pretty good.
Yes.
What the heck is happening?
So I think we're in this gold paradox where gold is signaling like a crash is coming, because gold is thought of as like that safe haven, and when gold starts massively going up, it should be a warning signal. So what I want you to look at is, I want you to look at the graph on the next page, and then we'll put this up on the screen. This is called the gold to oil ratio. And the gold to oil ratio is the number of crude oil barrels equivalent to 1 troy ounce of gold. And so look down at that timeline and then look at those peaks. All of those peaks are right at a recession or right before a recession. Early 1970s, mid 1980s, late 80s, early 90s, late 90s. Oh, great financial crisis. Oh, COVID. And then look where we're at today. Just shooting up. So what has to happen for this indicator to fundamentally change? The gold to oil ratio. Well, the gold to oil spread it breaks down the relationship, of course, between gold and oil. And what would cause this to plummet? Well, oil prices
Are going down.
Could shoot down, but oil prices are already low. And the Trump administration's drill, baby, drill. And so we're going to stay at a very stable level on oil prices. Well, what's that mean then? Well, it means gold prices have to come down. Well, why would gold prices come down? Gold prices peak headed into the recession. And when they go into the recession, they drop again. Okay, so here's the bet. Okay, not financial advice. Gold goes somewhere near 4,000, sits there for a second or two, and then goes boom, and its wings get clipped if we go into a recession. And you'll literally see it happening. Gold will literally collapse in front of your eyes, to the point where my father-in-law, who's been a coin collector since he was a teenager, he said to me, and there's just wisdom. Old people have like distilled time wisdom, and you can't get it from anyone else, because they've seen it so many times. And he goes, gold's getting really high. It might be time to sell some gold and rebuy. And he said that, and I was doing the research for this, and that he said that literally like 3 weeks ago. And I'm looking at it going, you know what? Bob's probably really right. And so I'm giving you all the data. Now I want to give you my personal playbook. And this is how to prepare for a soft landing, no landing, stagflation, deflation. And my personal take is that the deflationary forces are going to win in the long run. Why? The U.S. economy has proven itself time and time again that we can make it happen, and we are the capital market of the world. And for that reason, what I'm going to be doing is actually pretty specific. I'm going to be watching rate-sensitive stocks and looking at real estate long term. And so I want you to think about this as your contrarian move. If you're an investor, this is not the time to panic. It's time to improvise, adapt, overcome. These forces at work are going to create massive opportunity, and I can feel it. I can see the sands kind of changing right now. So rate-sensitive stocks, buy the dip in September opportunities, owner financing, and ADU or massive value adds in real estate is specific what we're looking for. And I came up with these kind of 20 things that people should be doing. And these 20 things are to position yourself for whether we go through the stagflation, the soft landing, and position your money for a range of economic outcomes with a focus on real estate and general financial health. So we'll start with the real estate and we'll end with the financial health. I think you got to think about diversifying your real estate. Now, this could be geographically, and it could also be property type. Don't put all your eggs into just residential or commercial or industrial. Or what about different markets? Maybe if you're in one city, buy something in another city or a county or possibly out of state. I'm going to tell you I'm not leaving Washington State personally, because Washington State and the Seattle Metro, our overall economic outlook for this area specifically is way better than the rest of the country. But if I live in another part of the country, I'm probably going to consider investing in a metro like Seattle that has better economic numbers than, for instance, places in Miami right now.
Or Arizona.
Or Austin, Texas. And Austin's going to be a good one as soon as they bottom. Focus on cash flowing properties. So regardless of an economic client, we can't have enough income generating properties. And the same applies to the stock market. Dividend producing, cash flow. And I'm looking for consistent rental income that fights against the volatility of the market. And I'm looking for predictable returns. Consistency is key, because even if we go through a period of economic downturn or declining property values, that cash flow generally doesn't drop significantly. You can look at number 3, alternative real estate investments. I'm talking real estate investment trusts. I'm talking syndications with known operators. This is a way to diversify in real estate without the burden of direct ownership and dealing with the tenants, toilets, and hot water tanks yourself. Look for high demand, recession resistant sectors, number 4. This is properties that perform well in any economy. Mobile home parks, multifamily apartments that are affordable. I'm not talking luxury. I'm not talking the creme de la creme A-class. Storage facilities, data centers. Okay, data centers is a new one in this, but who's spending the most money in the country right now on CapEx?
Oh, like tech companies?
It's the tech companies on AI and data centers. Number 5, utilize debt strategically. In a high inflation environment, fixed rate debt becomes a weapon, a powerful tool. Now, don't get over indebted, but realize fixed rate debt, if inflation rose, is a hedge. And if inflation comes down and rates come down, you can just keep refinancing. And then find and get owner finance deals. Guess what we're getting today? Another owner finance deal. I've been preaching about it. Go find them out. Number 6, seek these crazy value add opportunities. So instead of buying at the top of the market, look for properties that are undermanaged, or they need value add, or they need renovation, and you can force appreciation inside of the real estate. My current favorite play here in the Seattle Metro is the ADU. It's the most accessible one. And because multifamily is beat up And we have a lot of this commercial debt that's still out there floating and it's going to have to be refinanced. Multifamily, if you can get it at a good cap rate and then do value add, is going to be great. Just realize you're going to have a significant down payment or large cash coming in from a 1031. Multifamily, big stuff is very hard to finance. I'm talking 50 to 60% LTVs right now. You're probably not going to get 75, 85. And if you can, you don't want that debt today. Number 7, hold adequate reserves for your real estate. Start stacking up 6 months worth of reserves in the account for the mortgage, for the repairs, whatever the repairs were, whatever the mortgage was. Stack that into the account. Have those excess reserves there. This will prevent you from getting into a forced asset sale situation if the market transitions. Number 8, be prepared to buy in the downturn. Buy the dip is not just a stock market term. It is a real estate term. If we go into recession or deflation, it may present significant opportunities to buy at a discount. Have the capital ready to deploy. 9, P.S. Nobody does this one. Secure your rental income. In commercial real estate, that means vetting your tenants and negotiating long-term leases with automatic escalations built in. But call your tenants and check in on them. How is their business doing? Are they going to be there? Do the same thing on your residential side. Go double check your tenants. Go double check your leases.
Why does nobody do that?
Because we get lazy, because the check starts showing up and we believe that everything's going to stay the same. So we don't take the time to go do the due diligence and recheck our investments, to recheck our original thesis, to prepare for the worst. Also follow up with the property management. How are they doing? What do they think the holes and the weaknesses are? When you ask them this question the first time, Benji, they always kind of gloss over it. Hey, who do you think's at risk? Oh, I don't know. Go do the homework and get back to me with a list of who you think that we're currently renting to is at a risk. And then I want you, number 10, to assess and mitigate your risk inside of your portfolio. What that means is you need to go evaluate which ones are performing well, which ones are really hard to rent. If it's hard to rent today and the economy got worse, is it going to get easier or harder?
Get harder.
Massively harder. Massively. Maybe you need to sell that one today and just get into an easier to manage asset. Now let's move into the second part of this. These last 10 are about your general financial health. You need to diversify your entire portfolio. Spread your investments across different asset classes, equities, fixed income, commodities, bonds, real estate, different types of real estate. That's a defense against an economic downturn. Okay, this doesn't have to be permanent, but we need to be prepared just in case this gets worse. Because if you look at the way Jerome Powell was talking before, I'm not going to cut, I'm not going to cut, I'm not going to cut. And then magically, all of a sudden, he's ready to cut. When we get a really bad jobs report, it's because the data is looking like shat. S-H-A-T, shat. And if the data gets worse, this is going to get worse. Increase your access to alternative investments. Alternative investments could include things like hard money, real estate partnerships, private equity, venture capital. These are often less correlated with the economy or public markets. Or maybe you go look at a small business that's got a good track record and you invest in that small business, who's got increasing revenues, who just wants to grow their business, not someone who is brand new starting a business. I want you to hold more cash. Number 13, hold more cash and cash equivalents. This gives you flexibility if a problem arises. It gives you liquidity to buy the dip. 14, invest in something like inflation-protected securities. So a treasury inflation-protected security is a TIP. These are government bonds that are issued as a protection against inflation, and they rise with the CPI. Number 15, maintain a flexible capital structure. So this is all of your financial leverage is kept in check. You're not over-leveraged on any of your assets. And that's real estate. That's margin on your stocks and bonds. That's lines of credit. That's credit cards. That's cars. Nobody needs a $1,500 a month car payment. You don't have to have that thing that you're trying to use for buy now, pay later. Let's maintain flexible capital structure. 16, Prioritize tax-efficient strategies. Death and taxes. These are our only certainties. Meet with your accountant and your tax strategist once a quarter. Take advantage, if you're self-employed, of contributions to your IRA through your SEP. I believe it's like 62 or 68,000 you can contribute. It's a massive amount of money. Look at contributions to your IRA. Look at bonus depreciation like we've been talking about to massively wipe out taxes in real estate. Look at putting money into oil and gas where you can get the big write-offs from the IDCs. 17, plan for different scenarios. Why don't you write down 5 scenarios? Write down what you think is going to happen, and then write down what you would do if these things happen. Create a thesis on where the market is going, and then constantly go revisit it as the data becomes available. But also, this podcast has been, this episode, a little bit more negative. Realize I am almost a perma-bull and I am a super optimist, but I want you to go in with your eyes wide open. You got to be paying attention because it's turbulent. 18, develop a long-term investing strategy. We have to know why we're doing it and why we're doing it for the long term. Let's not be short term today. Number 19, build a network of amazing advisors and experts. If you have a team of professionals, which includes financial planners, which includes accountants, tax advisors, attorneys, real estate people, builders, developers, investors, bankers, this specialized knowledge and their collective wisdom will help you navigate the complex future we're currently heading into and changes in the financial and legal landscapes. Last but not least, invest in yourself and in your business. The best defense against economic uncertainty is a strong income stream and a strong knowledge basis, because that's how you can get into business opportunities, into investment vehicles that create, during these economic times, generational wealth. And the thing to understand that is, if for some reason, heaven forbid, you lost everything, they can never take that knowledge away from you. So in this episode, we've covered a lot about deflation, economic forces, and what you should be paying attention to over the next week and the coming months. And then realize, watch the data. What's my plan? What am I doing with my assets? And how am I capitalizing on this opportunity? Because whether the market is up, down, or sideways, and I'm talking the economy, real estate, stock market, you need a way to be able to make money in all those situations, protect your family, and buy the dip. I'm Anton Stetner. We're here in the Seattle Metro to help you guys with real estate. Hit that magic subscribe button if you guys like talking about real estate investing, money in the economy. Hit us up for all your real estate needs and send this to a friend who needs to hear this and plan for the future, because we're slightly uncertain, but that's also creating a lot of opportunity.